Hello, welcome to Morris Money, where we give you stock tips in under 5 minutes. I'm your host, Morris Willie. Before we begin, I'd like to say thank you to the Seeking Alpha article that some of this video was based off of and we'll be referencing in the video. Now, let's begin. Down another 20% from Friday, could it be time to invest in DIDI? Considered the Uber of China, I consider DIDI a growing giant. Due to recent regulations from the Chinese government, this could be false. The company has faced tough regulatory scrutiny after a cybersecurity privacy issue and, more importantly, listing on the United States exchanges and not Chinese ones. I can understand why the government is upset. If you do business in our country, at least list on our markets. This is equivalent to Ford or Coca-Cola wanting to list on the Chinese exchanges while doing business in the United States. With the regulating beatdown of Chinese stocks, it's time that we search for good deals, and there's no better deal than DIDI right now. DIDI started trading on June 30th, 2021. After seeing an initial pop, the stock has been downhill ever since. Currently, DIDI is down 43% from June 30th, giving room for the stock to grow massively. The most severe risk DIDI has at the moment is delisting from American markets. Forcing a company to delist from the U.S. exchanges will be an unprecedented move for China. The main risk of investing in DIDI Global in the long run is delisting, as the terms can be quite unfair. There are currently no indications of those terms, but maybe if the delisting is forced. But it's not going to do well by the company. I doubt this could happen, but Chinese regulators could force DIDI to list on a Chinese exchange. This wouldn't necessarily be a bad thing, but could interfere with the current share structure. Besides delisting, the company may pay numerous fines, but I don't think it will be anything too severe, as I don't see China wanting to hinder one of its largest growing companies. I don't think the beatdown is over yet for DIDI, but as we're seeing prices under $9, the returns could be massive. Price targets see the stock in the $25 range, which is manageable. But overreaction is the name of the game currently with Chinese stocks, and this is how you have to invest. DIDI and Alibaba are both names we're looking at because both have massive upside and are beat down over regulation concerns from the Chinese government. I'd give DIDI a couple weeks to settle down, as we could see further downside for the stock. If we see below 50% returns from June 30th, I'd like to buy. One, because I know I have at least 50% returns from that point, but in addition, it just sounds like a solid number to start at. DIDI isn't going anywhere anytime soon. Chinese regulators are just giving us a great deal to start buying from, with price targets reaching $25, giving us an over 200% return, potentially. This is a no-brainer stock to invest in. Please don't take this video as financial advice, and thank you for watching Morris Money.